Those dirty, rotten, low-down, money-grubbing commission hounds. Or whatever else Dave Ramsey says about whole life insurance agents. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our EncycloMedia series, I want to talk about policy splits as it relates to policy structure for the purpose of implementing infinite banking as conceived and codified in R. Nelson Nash's book, Becoming Your Own Banker, using whole life insurance. Now, as you start looking at infinite banking and listening to things, reading things, you might hear this term policy splits. What that generally means is that of the total premium that you would pay to a policy, a whole life policy, if you're actually going to be doing infinite banking, to a whole life policy, part of that premium is going to go to the base policy itself, the whole life policy itself. The chassis, the skeleton, the foundation, the framework, if you will. And the other portion of your premium, making a full 100% of the total premium that you're going to pay, goes to building cash value in the paid up additions rider, which also buys death benefit. So you'll hear numbers thrown out there like 1090, or you'll hear the incorrect inverse, in my opinion, 90-10. So typically speaking, you should consider the first number as the portion that goes to the base whole life policy itself. And then the second number is going to be what goes to the paid up additions rider. Now, part of what goes to what's considered the base or the first number might also include a mandatory premium to keep such a policy in force to a term rider. But 1090, 4060, 5050, 2575. These are some typical numbers that you're going to hear thrown around there. So I've already done an episode on policy structure, but let's particularly break down policy splits here one piece at a time. The base portion of the policy is the mandatory premium that you have to pay to keep the policy in force. Now, whether that's paid out of pocket or from future growth within the policy itself or dividends reducing the premium, regardless, that's going to be paid from somewhere to keep that policy in force all the way up to that policy's maturation. Now, with it being a whole life insurance policy, it could be a 10 pay, it could be a 20 pay. It also could be a paid up at age 65, paid up at age 75 or 70. It could be a paid up at 100. It could be a paid up at 121, meaning when you're 121 years and you're still alive, then that policy matures, you'll just be paid the death benefit. But everything that kept that in force was the base premium. So it is mandatory to keep the policy in force. So it is your contractual obligation, would be another way of saying it. And it guarantees you a death benefit. It guarantees you a cash value. And it contributes to the robust nature, the stable nature of a life insurance policy being a whole life policy, meaning that it is for your whole life. Level-based premiums for the whole life policy. Now, the paid up additions rider is the contractual opportunity that you have. It is the contractual right or ability to pay more premium that does buy you more death benefit, that does create early cash value sooner. It creates cash value always when you pay paid up additions premium into that rider, but the paid up additions rider is what creates an early cash value in a policy because the base premiums are typically not going to create a cash value that you could use for leveraging for infinite banking purposes for some years, whatever that may be. But the paid up additions rider is an optional portion that you can pay. Now, there may be a minimum. A company may say, well, you have to pay this amount every month or every year to be able to maintain this rider. But you, after that, of course, have the option to pay however much that regular scheduled amount of premium into the paid up additions rider is. And some companies will even let you pay extra above and beyond your regular scheduled ongoing premiums, even to the paid up additions rider. So premiums paid into the paid up additions rider create bigger dividends. They buy more paid up death benefit. You have a contractual right to pay those, but not a contractual obligation. It can create an early significant cash value in the policy. And generally speaking, the longer that you can pay into the paid up additions rider and the more that you're allowed to pay into the paid up additions rider and the more flexibility that you have to pay into the paid up additions rider, the better off you are. And this number, I say second when talking about policy splits, 40-60, for example. That 60 comes after the 40 because there is no paid up additions rider if there's not a whole life policy contract to add that rider to. So that's why I would say a 40-60 policy is one that's been built with 40% of your premium going to the base policy itself and 60% going to the paid up additions rider. Now, this aspect of policy structure, because talking about policy splits is not talking about policy structure comprehensively, but this aspect of proper structure when talking about policy splits is important because out there in the wide world, there are those who would build policies with 10% going to the base and 90% of the total premium going towards the paid up additions rider. And I'm not saying to do that, not do that. I don't personally own policies built that way. And for a few reasons, what I would ask you to consider is a few things. Number one, recognize that the fragility of your policy, to use a word from Ryan Griggs, the fragility of your policy increases when you have too much or such a high percentage of your total premium going to the paid up additions rider. Fragility as far as MEC status is concerned, for example, or lapse status. And then if there are any other additions to that policy, that fragility can increase. So let's say a policy has a 10-90 design when it comes to the policy split, 10% going to the base, 90% going to the PUA. And then it also has a term rider, or it also has an enhanced blended term rider. By the time you add in these different variables, just understand that right out of the gate, that does inherently make that type of a design more fragile than a more robustly built policy like a 40-60 policy. Now, 40-60 is not going to make sense for every situation, nor is 50-50, nor is 25-75, nor is any policy split. I personally believe that policies should be built for the individual, appropriate for where you're at, where you're going, how you plan on using your policy, what your financial footprint looks like, how you see yourself using the policy, etc. A policy should be built for the individual. And overarchingly, I'm going to say that, like Nelson in his book, when you know what's going on, you'll know what to do. So again, policy split is an important part of your proper structure conversation, but it's not all that there is to it either. But again, I want you to be aware that the more variables that are introduced into your policy structure, it can add to the fragility of that policy. Another consideration is that, generally speaking, premium that goes to the PUA rider creates that early cash value like we've already discussed. However, the opposite side of that coin is recognizing that the greater percentage of your premium that goes to the base policy itself means that more cash value will be created in the long range over your lifetime from those premiums. So this idea of front loading a policy, dump ins, we didn't even mention dump ins a second ago. If you add a dump in, I'm not saying that you can't add a dump in. I'm saying that it should be appropriate for you, but also a dump in can add more fragility to your policy structure. But again, let's say you're trying to add a dump in and you have some term on your policy and you've got an aggressive policy split where you've got 10% or 20% going to the base and 80 or 90 going to, it's just creating a policy that perhaps is accomplishing some short-term goals, which is going against Nelson's first rule, which is think long range. You can accomplish a lot with a proper structure on a policy while still thinking long range. And that's where the base premium is so important, because it's the base premium over your lifetime that's going to generate a greater and exponentially growing amount of cash value relative to the premium dollars that are paid. So if you're only putting 10%, 20% of your total premium towards the base, that's going to show up in later years. Furthermore, dividends are paid more relative to the amount of premium that you have going towards the base policy itself than to the paid up additions. You earn greater dividends. Let me say this simply. You earn greater dividends based on the base premium that you pay than the paid up additions, which it might not be there for the lifetime of the policy, but base premiums will. You may be short range thinking where you're just planning on putting this one-time big down payment, and then you're not really trying to build this warehouse of wealth where you are seeking to accommodate a volume of capital, and probably an increasing one, over your lifetime, which again becomes very relevant when you consider dividends. And if this is a policy that you anticipate using come passive income or retirement age in life, the base premiums are going to dictate the relevancy that that policy plays in providing you with passive tax-free access to capital at that stage of life, much more than paid up additions. And something should be said about a term rider. A term rider, because a term rider is likely going to be a mandatory portion of your premium to avoid mix status, depending on how your policy is structured. The term policy should be considered as part of the base premium, essentially, whatever that split is, whatever that amount of insurance costs you. Term insurance in a dollar amount, in a premium amount, it's going to be weighed towards that first number and not the second number, which is optional buying that paid up additions. Now, just because I mentioned dividends, if you would like to know more specifically about dividends, make sure to check out our EncycloMedia episode number 4 to learn more about dividends. Also, let me address something that you might hear out there concerning commissions as it relates to policy splits, because there are those individuals out there, whether consumers or professionals, who will try and disparage one way or another. They might try and disparage someone for building a robust policy split, such as a 50-50 or a 40-60, by saying, well, you're just a commission hound. You're just trying to increase your commissions. Recognize this. Two things. On one hand, when you structure a policy that's not 100% base, but you actually structure 60% of that towards a paid up additions rider, which is in that particular split the lion's share of the premium amount, you're not, as an agent, going to be compensated at the same rate on paid up additions premiums as you are on base premiums. So actually, by constructing policies for the purpose of infinite banking in general, the agent or advisor is foregoing the compensation that they would have received if they were just building a plain Jane, vanilla, straightforward, all base, whole life insurance policy. And in the same breath, I can say that for individuals who are actively seeking and authentically seeking to pay a significant amount of premium, that does change the conversation as it comes to compensation, because an individual that's going into a box store, speaking with a box store agent, just trying to get as little of a premium as possible for the greatest amount of even a whole life guaranteed death benefit as possible, is a very different scenario than someone coming seeking to pay a significant percentage of their cash flows in premiums for whole life policies, even if that policy is built in a 40-60 manner. But here's where I'd like to jump in and say too, that I want the professionals in my life that I use, that I reach out to be there the second time that I reach out to them, and the third and the fourth and so on. I mean, I understand that this industry and many others who doesn't have a brother-in-law or whatever that's doing insurance or real estate or what have you. Okay. It's interesting how those same are not doing mechanic work, or they're not being chiropractors, but Be that as it may, those two industries in particular, perhaps it seems, right? Everybody and their brother knows somebody in real estate, insurance. It's interesting. But I get this all the time that somebody was working with somebody else and they just wouldn't pick up the phone and they get in touch with me. Or so-and-so reached out for help with something and their agent wasn't even in the business anymore. So it's got a high turnover as an industry. And that's one reason why I really appreciate what I do. I'm an insurance agent. I'm licensed as an agent, but I'm doing this one thing. I'm helping people create a private family banking system for the purpose of autonomy and financial independence. That's it. Whole life insurance from mutual companies that pay dividends. That's it. So I've mentioned term riders. I've got 2 episodes for you in our EncycloMedia series. To have further details on those, I covered term riders in episode 11 of our EncycloMedia series, and I covered convertible term riders in episode 12. But this has been a great pleasure for me. If you would let me know down in the comments section below what your takeaway was. If you got some new piece of information here for the first time, I'd love to hear about that, or put a question if you have a question about what you've heard. Otherwise, if you've not yet seen my full introductory presentation or had a conversation with me, both of those are free on our website, durhamtalents.com. This has been a great pleasure for me. I look forward to our next conversation. My name is Jesse Durham. Live and leave a lasting legacy. Have a great day.